Have you ever bought gold or silver, watched the price fall the very next day, and immediately thought, maybe I should have waited? Or perhaps you've waited for the perfect dip, only to watch prices climb higher without ever giving you the opportunity you were hoping for. If that sounds familiar, then you're not alone. In fact, this is one of the biggest psychological battles every precious metals investor faces. It doesn't matter whether you're buying your first 1 ounce silver coin or building a six-figure portfolio of physical bullion. At some point, every investor asks the same question: should I buy now or should I wait? The truth is, this question has cost investors more opportunities than almost anything else. Not because waiting is always wrong, and not because buying immediately is always right, but because most people never develop a clear investment system. Instead, every price movement forces them to restart the entire decision-making process. One day gold is up and they panic because they think they've missed the rally. The next day silver drops 3% and suddenly they convince themselves it will fall another 10%. Before long, weeks turn into months, months turn into years, and they still haven't built the position they originally planned to own. Welcome back to Macro Bullion. I'm Alex James, your independent gold, silver, and macroeconomic analyst. On this channel, we don't chase hype or emotional headlines. Instead, we study economic cycles, precious metals, inflation, central banks, debt markets, and long-term wealth preservation. If you're serious about understanding where gold and silver fit into today's financial world, you're in the right place. Today, we're going to answer one of the most important questions every precious metals investor eventually asks. How often should you buy gold and silver? Should you invest everything today? Should you buy every month, every quarter? Or should you simply wait for what looks like the perfect buying opportunity? More importantly, which approach has historically helped investors stay consistent instead of becoming trapped by emotions? Before we answer that question, there's one thing we need to understand. Many new investors believe successful investing is about predicting the perfect entry price. They spend hours studying charts, watching financial news, and following social media influencers who promise to know exactly where gold or silver will trade next week. But the reality is very different. The investors who quietly build substantial precious metals portfolios are usually not the people who correctly predict every market movement. They're the people who develop a disciplined process and simply stick to it. Think about it. If someone bought physical gold 10 years ago, do you think they still worry about whether they paid $20 or $30 too much for each ounce? Probably not. What matters far more is that they actually accumulated the asset instead of endlessly waiting for the perfect price that never came. According to the source material, there are two entirely reasonable ways to build a precious metals position. The first approach is simple. If you already have the capital available, know exactly how much gold or silver you want to own, and you're comfortable holding through market volatility, then making one larger purchase can be a perfectly sensible strategy. Once you've established your desired allocation, there is no rule saying you must continue buying simply because other investors are doing so. The second approach is equally valid. Instead of investing one large amount, you gradually build your position over time as money becomes available. This is commonly known as dollar cost averaging, or DCA. Rather than trying to predict market highs and lows, you consistently invest at regular intervals, allowing your average purchase price to develop naturally across different market conditions. Notice something important here. Neither strategy is automatically better. They're simply designed for different financial situations. Someone with $50,000 sitting in cash may reasonably choose a lump sum purchase. Meanwhile, someone investing from their monthly salary has an entirely different challenge. They aren't deciding what to do with $50,000 today. They're deciding what to do with $1,000 that becomes available every month. And that's where most investors make their biggest mistake. Instead of following a predetermined plan, they allow every price movement to become a completely new investment decision. Gold rises, they hesitate because they think it's too expensive. Gold falls, they hesitate because they fear it could drop even further. Silver rallies, they assume they've already missed the opportunities. Silver corrects, they become convinced the bear market has only just begun. Without realizing it, they're no longer following a strategy. They're simply reacting to emotions. And emotional investing has destroyed more wealth than almost any market correction ever could. We're going to build a practical buying system that removes emotion from the process. We'll discuss whether monthly, quarterly, or annual buying makes the most sense, why buying too frequently can actually cost you more money, and how professional investors create a rhythm that allows them to accumulate precious metals regardless of what tomorrow's headlines say. So now you've established your investment rhythm. You've decided how much you can comfortably invest each month, and you've chosen a buying schedule that fits your financial situation. But another important question now appears. If you're planning to own both gold and silver, how do you decide which one deserves your next investment? Should every purchase be split 50-50? Should you always buy gold because it's considered the safer monetary metal? Or should you focus on silver because it has historically shown greater upside during major bull markets? This is where many investors begin overcomplicating what should actually be a very simple decision. Every day you'll find someone on social media claiming that silver is about to outperform gold by 300%. The next day, someone else insists gold is the only true safe haven asset worth owning. One analyst points to industrial demand for silver, another highlights central bank purchases of gold. Before long, investors become overwhelmed by conflicting opinions and forget that they already had a long-term plan. The source material introduces a useful tool that can help guide these decisions without forcing investors to predict short-term market movements. That tool is the gold-to-silver ratio. Rather than trying to forecast tomorrow's prices, the ratio simply compares the relative value of the two metals. It tells you how many ounces of silver are required to purchase 1 ounce of gold at current market prices. The source emphasizes that this ratio is intended as guidance, not as a strict rule, and is only relevant if you've already decided that holding both metals aligns with your investment objectives. Think of the gold-to-silver ratio as a compass rather than a GPS. A compass points you in a general direction, but it doesn't tell you every step you must take. In the same way, the ratio doesn't tell you exactly what to buy today. Instead, it helps you understand whether one metal appears relatively expensive or relatively inexpensive compared to the other. According to the source, when the ratio is unusually high compared with its recent range, an investor might choose to direct a larger portion of their next purchase towards silver. Conversely, when the ratio is unusually low, they might favor gold. If the ratio sits somewhere near its typical range, they may simply continue buying according to their normal allocation. The important point is that these are optional adjustments within an existing strategy, not attempts to predict next week's market direction. This distinction matters more than most beginners realize. Many investors see a high gold-to-silver ratio and immediately conclude that silver must be ready to explode higher. But that's not what the ratio actually tells you. The ratio does not predict future prices. It simply describes the relationship between the two metals at a given moment. Markets can remain at unusually high or unusually low ratios for extended periods. That's why using the ratio as a guide rather than a guarantee helps investors stay disciplined instead of becoming overly confident. Now let's consider another factor that often surprises new precious metals buyers. The price you see quoted on financial websites is not necessarily the price you'll pay when purchasing physical gold or silver. This is one of the biggest differences between investing in physical bullion and buying a stock or exchange-traded fund. When you purchase physical metal, you're not just paying for the raw metal itself. You're also paying for minting, refining, fabrication, transportation, dealer margins, insurance, storage, and sometimes shipping. These additional costs are commonly referred to as premiums. And depending on market conditions, those premiums can change significantly. For example, during periods of exceptionally strong demand, physical silver products may sell out quickly. Dealers may then increase premiums because replacement inventory becomes more difficult to obtain. In that situation, even if the spot price of silver falls slightly, your total purchase price may not decline by the same amount. In some cases, it may even rise. That's why experienced investors don't focus solely on the spot price. They focus on the total acquisition cost. The source explains that buying physical bullion involves evaluating not only the market price of the metal, but also the premiums, delivery charges, storage expenses, and the actual amount of metal you'll receive. A lower spot price doesn't automatically translate into a cheaper purchase if premiums have increased substantially. Likewise, a slightly higher spot price may still represent better value if premiums have declined or if you're purchasing a more cost-efficient product. This is an important mindset shift. Successful precious metals investing isn't about winning every transaction. It's about building ownership of real assets in the most efficient and sustainable way possible. Because over the long term, the difference between emotional buying and systematic buying can be far greater than the difference between purchasing gold at one price versus another. We'll look at why buying too frequently can sometimes reduce the amount of gold and silver you actually own, how premiums affect different bullion products, and how experienced investors maximize every dollar they put into physical precious metals. By now, you've probably realized that building wealth with physical gold and silver isn't just about buying at the lowest possible price. It's about creating a system that you can follow through bull markets, bear markets, economic booms, and financial crises. But there's one final lesson that separates experienced bullion investors from beginners, and surprisingly, it has very little to do with predicting the market. It has everything to do with understanding the real cost of owning physical precious metals. This is where many first-time investors make an expensive mistake. They spend hours watching the spot price of gold or silver. Every morning they check the markets. Gold is up 1%, silver is down 2%. They become become excited when prices fall because they think they'll be able to buy more metal. But when they finally visit a bullion dealer, they're surprised to discover the actual purchase price hasn't fallen nearly as much as they expected. Sometimes it hasn't fallen at all. Why does this happen? Because when you buy physical bullion, you're not purchasing numbers on a trading screen. You're buying a real, tangible asset that has been mined, refined, minted, transported, insured, stored, and delivered before it reaches your hands. The source explains that the final purchase price includes much more than the headline spot price. Fabrication costs, dealer premiums, delivery charges, storage fees, insurance, product availability, and market demand all influence what you'll actually pay. These additional costs are a normal part of the physical bullion market and should always be considered before making a purchase. Let's make this practical. Imagine two investors each have $500 available every month for silver. The first investor decides to buy every single week. That means 4 purchases of approximately $125 each month. On paper, it sounds incredibly disciplined. They're buying more frequently and spreading their purchases across different market prices. But here's the hidden problem. Each weekly purchase may involve separate shipping charges, payment processing fees, and higher premiums because smaller silver products generally cost more per ounce than larger bullion products. By the end of the month, those repeated transaction costs have quietly reduced the total amount of silver they actually own. Now let's look at the second investor. Instead of making 4 separate purchases, they save their $500 throughout the month and make one carefully planned purchase. They pay shipping only once. They qualify for a larger bullion product with a lower premium per ounce. The result? Even though both investors committed exactly the same amount of money, the second investor may finish the month owning more physical silver. This perfectly illustrates one of the most important ideas in the source material. Buying more often does not automatically mean buying more efficiently. The same principle applies to gold. Many beginners start with fractional gold coins because they're more affordable. There is absolutely nothing wrong with that. Fractional coins allow investors to begin building a position without needing thousands of dollars for a full 1-ounce coin. However, there's an important economic trade-off. Because manufacturing costs are spread across less gold, smaller coins generally carry higher premiums per ounce than larger bullion products. Again, this doesn't make them a bad purchase. It simply means investors should understand exactly what they're paying for before making a decision. This is why experienced investors don't just ask one question before buying. They ask several. How much actual metal will I own? What premium am I paying? How much is shipping? Are there storage costs? Would waiting one more month allow me to purchase a more cost-efficient product? These questions often have a greater impact on long-term results than trying to predict whether silver will move $1 higher or lower next week. The source makes another excellent point that many investors overlook. If your regular monthly investment isn't large enough to purchase the product you really want, that doesn't mean you failed your investment plan. It simply means you should continue saving according to your schedule while making the physical purchase every 2 or 3 months instead. Your saving habit remains monthly, but your buying habit becomes more economically efficient. That's not inconsistency, it's intelligent planning. This distinction is incredibly important because successful investing is built on flexibility within a disciplined framework. The habit stays consistent. The execution adapts to reality. That's exactly how professional investors think. They don't chase activity, they pursue efficiency. Another lesson hidden inside this approach is psychological. When every purchase is carefully planned, investors stop obsessing over daily price movements. Instead of asking, should I buy today? They simply follow the schedule they've already established. The decision has already been made weeks or even months in advance. That removes one of the biggest enemies of successful investing. Emotion, fear, excitement, greed, regret, and panic begin losing their influence because your investment process no longer depends on tomorrow's headline or the next market correction. And that brings us to the final piece of the puzzle. We're going to bring everything together. We'll build a complete long-term strategy for accumulating gold and silver, discuss the biggest mistakes investors continue making, and explain why consistency, not perfect timing, has historically been the foundation of successful precious metals investing. Now, we've reached the most important part of today's discussion. Everything we've talked about so far, whether you invest a lump sum or build your position gradually, whether you buy monthly or quarterly, whether you favor gold or silver, and whether you pay attention to premiums, all leads to one simple conclusion. The investors who succeed over the long term are usually not the ones who perfectly time every market move. They are the ones who create a clear investment plan and have the discipline to follow it. Think about it for a moment. If you look back over the last 20 or 30 years, gold and silver have experienced incredible bull markets, painful corrections, periods of consolidation, and sudden breakouts. During every one of those phases, there were experts confidently predicting both spectacular rallies and devastating crashes. Some predictions proved correct, many did not, but one group of investors quietly continued building wealth throughout every cycle. Those were the investors who stayed consistent. They didn't panic every time gold corrected by 5%. They didn't chase silver after every major rally, and they didn't allow every news headline to completely change their investment strategy. Instead, they understood one very important principle. The purpose of owning physical gold and silver is not simply to make a quick profit. For many investors, it's about preserving purchasing power, diversifying wealth, and owning an asset that exists outside the traditional financial system. The source material emphasizes that before making any purchase, investors should first decide which approach they are following. If you already have the capital available and feel comfortable holding through market fluctuations, then establishing your desired allocation in one purchase can be entirely reasonable. On the other hand, if you're building your position from regular income, then consistency becomes far more important than trying to identify the perfect entry point. The mistake isn't buying once or buying regularly. The mistake is having no settled approach and allowing every price movement to reopen the entire decision-making process. That idea may sound simple, but psychologically, it's incredibly powerful because once you've made your decision, something remarkable happens. You stop asking yourself every week whether today is the right day to buy. You stop refreshing gold charts every hour. You stop worrying because silver moved 2% overnight. Instead, your investment process becomes automatic, and automation removes emotion. That's exactly what successful investing should do. Let's imagine two investors. The first investor spends every day reading headlines. One economist says inflation will rise. Another predicts recession. One bank expects gold to rally, another believes silver will decline. Every opinion changes their confidence. As a result, they hesitate constantly. Months pass, years pass, and despite all their research, they've accumulated very little physical bullion. Now consider the second investor. They decide they'll save a fixed amount every month. When that amount reaches the most efficient purchase size, they buy physical bullion. If the gold to silver ratio favors silver, they may allocate slightly more toward silver. If it favors gold, they adjust accordingly. Then they go back to living their lives. They're not trying to outsmart the market every week. They're simply following the system they designed. 5 years later, who do you think owns more gold and silver? In most cases, the answer isn't the person who predicted prices most accurately. It's the person who stayed consistent. Another important lesson from the source is that investors should evaluate the total cost of ownership, not just the headline spot price. Premiums, fabrication costs, shipping, insurance, storage, and the type of bullion product all influence the final purchase price. Sometimes waiting until you've accumulated enough savings to purchase a larger, lower premium product can be more efficient than making several smaller purchases. The source suggests maintaining the monthly saving habit while executing the physical purchase every 2 or 3 months, if that results in better overall value. This is exactly how long-term thinking works. You're not trying to win every transaction. You're trying to improve the efficiency of your overall strategy. That shift in mindset changes everything. Instead of thinking like a trader, you begin thinking like an owner. And owners think differently. They focus on years, not days. They focus on accumulation, not excitement. They focus on building real wealth, not chasing headlines. So where does all of this leave us? It leaves us with 3 simple principles. First, decide whether you're making a one-time allocation or building your position gradually. Second, choose a buying rhythm that fits both your income and your financial responsibilities. For many investors, monthly works well. For others, quarterly may be more practical. The important thing is sustainability. Third, if you own both gold and silver, use tools like the gold to silver ratio as guidance, not as a prediction. Let it help fine-tune your allocation without allowing it to completely change your long-term strategy. And once you've made your purchase, move on. Don't spend the next week wondering whether you should have waited another day. Don't let tomorrow's price become a judgment on today's decision, because no investor, no analyst, no economist, no central banker can consistently predict every short-term movement in the precious metals market. What you can control is your discipline. You can control your savings, you can control your buying plan, and you can control your emotions. Those are the factors that ultimately determine long-term success. If you found today's analysis helpful, make sure you subscribe to Macro Bullion and turn on notifications so you never miss our latest deep dives into gold, silver, inflation, central banks, global debt, macroeconomics, and wealth preservation. I'm Alex James, and I truly appreciate you spending your valuable time with me today. Until next time, stay informed, stay patient, protect your purchasing power, and as always, This analysis is for educational purposes only and should not be considered financial advice. Always verify current market data, compare premiums from trusted bullion dealers, and conduct your own research before making any investment decisions. DYOR, do your own research. Taktespect des Eis Ors.